Hello friends, I begin this video with a sincere word of thanks. The last 2 or 3 weeks have been really gratifying from the job satisfaction point of view. My social media pages have seen a lot of my viewers joining me on my social media accounts. We've had a lot of lovely conversations going about the markets, and it's really exciting when you meet intelligent people who go beyond the surface and look deep into the markets, just like I do in my videos. I've shown you a lot of studies which are not available in the public domain. These are in-house tools and statistical studies from our model, which we fondly call the Barracuda. And over a period of time, I intend to open the doors to more and more of our tools, our techniques, and help my friends, my viewers become even better traders than we have this long. Friends, I'm Vijay Bhambwani, a trader with 35 years of experience under my belt, 28 of which are as a founder, promoter, and CEO of a limited company that trades for a living. In this video, I want to talk about what happened in the markets and, more importantly, share with you why, so that you not only catch a fish, but you also learn how to fish for yourself. And then we'll take a look at what to expect in the coming week. And don't go away till the end of the video, because towards the end of the video, at the fag end, I have important market updates for you. So what a week it was. The first half lived up to my expectation, and the thumbnail that I made last week of my video, the bulls are down but not out. Till Thursday, they proved me right. And magically speaking, the statistical data turned negative after I updated the data of Thursday evening, end of the day. And if you check my social media accounts, on Thursday evening I remarked I would be happy if the bulls even recover their cost of carry, which is the rollover expense that you incur to carry forward your long positions from one expiry to the other, since Thursday was an expiry day. I backed it up with a WhatsApp broadcast to my friends who choose to stay with me, connected with me via broadcast. I shared with you a brand new indicator that I shared with you last week in this video, called the impetus study. I sent an impetus study on WhatsApp to my entire broadcast list saying, and it was very early in the morning, much before the markets opened, that the impetus has turned negative and this is time for the market to decline. So if at all you are interested in staying in touch with me via WhatsApp, connect with me on social media, send a direct message giving me your cell phone number, and we'll get you going into our broadcast list. So even though the first half of the week was in line with what I said, the bulls are down but not out, the last day turned out to be a prophetic one. And what a dramatic change it was. When I shot off that WhatsApp message, I was kind of sure that the markets would decline, but the last 60 minutes of trade is something that I wanted to observe. Well, the last 60 minutes of trade on Friday turned out to be as bearish as the others, the other parts of the trading session. And what I really saw last week was the decline in last week was far more vicious as compared to the week prior to that. I saw a lot of round numbers, round figures being violated. I saw a lot of moving average supports being taken out, and the volumes on these breakdowns were significantly higher. So the panic level in last week was much higher. Now, as we return to the market and as the market roundup window shows on your screen, both the indices fell, the Nifty falling more than the Bank Nifty. Gold and silver also fell because a worldwide risk off was seen. Risk off meaning a shrinking of risk appetite, investors wanting to hold cash rather than holding any investments out of fear. And guess what triggered it? It's something that I have been telling you since many months, even though a lot of you may have found it boring. a worldwide rise in bond yields. I'll cover this in greater detail when we come to the bond section. And my followers and viewers have by now hopefully become experts at deciphering the bond yield markets and what to make out of it, the impact on the bank nifty and the banking stocks. So we'll get there in the debt market segment, but the Indian bond yields, as the roundup shows, rose a full 15 basis points or 15 paise. Now for the bond market, this is an basically earth-shattering event. It doesn't happen all the time. To add to the misery of the markets, and this is something also I have been telling you since many weeks, you must monitor the commodities market, particularly the oil markets, because 2/3 of all our imports are on oil. And oil prices rose, as you can see on your screen, which is a big negative for the market. And I call oil a multiplier commodity, because when oil prices go up, everything from milk, fruits, vegetables, grains, your spices, your clothes and everything, electronics, everything becomes expensive and stocks become cheap, which means they fall. And sure enough, you saw stock markets falling. Also note the United States dollar versus the Indian rupee, which shot through the roof. It can only be called as shooting through the roof on Friday. Now, I've warned you since weeks that emerging markets, including India, need a weak dollar, because we are import-dependent nations and everything that we import becomes expensive, thereby triggering imported inflation. Now, intelligent traders know that there are no such thing as coincidences in this market, and everything happens in financial markets for a reason, and the reason invariably is financial. Therefore, the dollar basically escalated the pressure which was triggered by bond yields, and the markets fell. So that's no coincidence. Now take a look at the MWPL chart, which is market wide position limits. Now this is something I discuss on my social media pages every day. Connect with me there and you can get these updates EOD or end of the day every day. Now this MWPL chart shows that the MWPL fell sharply, which is routine. The market-wide open interest has to fall on expiry, and thereafter bit by bit it rises gradually, and at the peak, which is around the 3rd week of the derivative cycle, it hits a peak. Now what I would be interested in is basically seeing whether the peak of MWPL reached in the 3rd week of March, is it lower, is it same, or is it higher than the February MWPL peak? If the MWPL March peak is lower, it will tell me that the risk appetite and the courage in the trading community has gone down. In that case, please beware. Now this MWPL study is something which you will not find in the public domain again. It is our in-house study. Now take a look at the volumes of the indices and the individual stock futures. Do remember that these are across the series, which means March, April and May futures. Now when you see the volumes, what is shown by the blue line here is the volumes of the index futures. It saw the volumes jump to a 19-day high. This is because long positions in stocks were being dynamically hedged by short selling the indices. Now, this is a natural phenomena. On the other hand, the stock futures saw volumes fall off the cliff because traders were shell-shocked and numbed by the steep decline on Friday. They didn't know what to do with their positions except nurse them. So they basically went into a shell, therefore causing stock future volumes to fall sharply. Now stick around till the end of this video like I told you, and I have a special market analysis for you on this topic itself. Now let's take a look at the basis chart. Now this is the premium the futures enjoy over the spot, which is called the basis. It jumped on expiry day, which is natural because suddenly the traders have 4 weeks to play for themselves. Therefore, the premium on the futures expands very rapidly. But it crashed frighteningly on Friday in spite of the fact that we now have 21 trading sessions, including a holiday, in the month of March before expiry. Now this has huge implications. Not only is there a mark-to-market problem for bulls, but even the call option buyers would have seen a severe shrinking of their call option premiums. And this also is likely to impact the put writers, bulls who have written puts to collect the premium or eat the premium. Now here again, the basis is something that I update daily on my social media pages, so do connect with me. And this again is our in-house Barracuda study, which you will not find in the public domain. We basically pioneered many of these studies, and slowly but surely we are opening the windows to our in-house studies. Sure enough, within some time these will be copied by the copycats, but that's all right. Now look at the chart of the impetus. Now this is a new indicator that I had opened our doors to from our in-house trading model, the Barracuda. Now on Friday morning, when I sent you a WhatsApp message saying that the impetus was warning about a decline, impetus had started to taper off in spite of the fact that the markets were rising. Note how there's a very sharp uptick in the impetus on Friday. But also note that Friday was a severe sell-off day in the market as far as prices were concerned. So impetus being nothing but acceleration, it tells you that the huge selling pressure actually accelerated the momentum, but unfortunately in the wrong direction for the bulls. Now if the prices are falling and the impetus is rising, which means the decline is going to gain momentum and the bulls are going to be slowly but surely being taken to the cleaners. Now here again, the impetus is something that I cover on my social media accounts, and you could connect with me and see this in real time. Now this impetus rising was triggered by what veteran Japanese candlestick traders called a morning attack phenomena. Now, the impetus itself is a leading indicator, which means it alerts the traders ahead and with the price rather than being a lagging indicator, which only tells you after a certain amount of decline has already occurred. So we would like to stick with statistical tools which are leading rather than lagging indicators. Let's now come to a very critical aspect of the market, the 10-year benchmark bond yield, which I feel I have been a forefront runner in this market and laying emphasis on this aspect because the bond market is the fountain of the money supply. You choke off the money supply and all markets will decline. This is something that you should question your expert advisors as to why they haven't been covering all this while, and why is everyone, including the media, only waking up to the fact of the bond yields after the decline has come, whereas we have been telling you since many months. Now from a range of 5.90 to 5.95, which existed up to a couple of weeks ago, the Indian 10-year benchmark bond yield, remember we are talking about government guaranteed bonds, the safest kind of security here, has jumped to 6.30%. What does it mean? It means that the high net worth individuals, the ultra high net worth individuals and the institutions which move the needles and the gauges of the markets with their big ticket checks are refusing to write out checks at lower interest rates. They want higher returns for their capital because inflation is rising, and they have therefore started demanding a higher cost of money. Now when monetary costs go up, cost of doing business also go up. Now this is something that your experts haven't really gone into detail to tell you, but we've been covering this since months. If cost of doing business is going to go up, and if cheap and easy availability of money is mother's milk to a bull market, what do you think when that situation reverses? Prices will also reverse. So are you surprised that the markets fell? Hell no. We have been forecasting this through my thumbnails, writing about whether the market is going to crash, whether the bulls are tired, whether the rally is going to terminate. And like I said, I've had fantastic conversations with newfound friends from YouTube and my social media accounts. We've had lovely conversations and ideas going, and we intend to continue doing this for you. So now that you're seeing the check writers, the people who write big ticket checks are fighting back falling yields. If you've invested in debt funds, the NAV of your fund is likely to be under attack right now. Ditto for your yields on your liquid funds, because the prices of the bonds have fallen and therefore there's a mark-to-market loss for both banks and individual investors, and the bank's bond portfolios fall, dragging the share price of the bank and by extension the bank Nifty. Now, as a bank Nifty trader, if you think you can ignore the bond yield market just because your experts are telling you not to look at anything but technical analysis charts, all the best to you. Have a profitable day. Now, don't let these ignoramuses fool you and tell you that bond and bond yields don't have a link with equity markets. By now, my regular viewers know that all asset classes have a pull and push impact on each other. Stay alert. Do your homework well and don't get caught by sudden large moves. Friends, the bond yields done. Let's now go to another very critical aspect which people normally ignore, which is the US dollar index. For an net import dependent nation like India, which imports 2/3 of its entire imports by way of fossil fuels, hydrocarbons, crude oil, natural gas, and like I mentioned, oil and gas is a multiplier commodity, the prices of which impacts everything from taxi and auto rickshaw fares to milk, fruits, vegetables, pulses, and grain prices. So the dollar determines everything. Now, you've seen in many of my videos how we basically take our trades seriously and we take into account as many aspects as possible to achieve success in our trades. And therefore, forex markets are something that should not be left out. Look at the Dixie chart on your screen, and it basically shows a bullish base formation, and the price is closing above its 25-day exponential moving average from now. If it climbs and stays above the 91.5 mark, it will energize the bulls to get more aggressive, and it might even trigger short covering by the bears. Why should it be important to you? Because, like I said, it will have a bearing on everything, including inflation, and inflation will directly impact bond yields, and bond yields will directly impact banking stocks and the bank Nifty. So, as you can see, there is a chain reaction. Each thing is linked through a link in this chain to each other. And a weak rupee also means higher inflation. And take the case of crude palm oil. If you're eating vada paos on the road, you will basically see it's fried in crude palm oil. It's essentially an imported item. And the prices of crude palm oil have doubled in the last year and a half. And this is an imported item. 88% of it comes from Malaysia and Indonesia in the world. So savvy traders know this aspect and monitor this very seriously. Note that the price on the daily chart has risen above a falling wedge and created a broad base between 88.5 to 89.5. All we need is a breakout now about 20 and 91.5, and you'll see the bulls get back in action. On the weekly chart also, as you can see, the dollar index is basically climbing. So on the weekly chart, as you can see, the dollar index climbing. Last week, I advocated a range between 91.45 on the upside and 89.25 on the downside, which held perfectly well. The coming week is likely to see an estimated, I repeat the word estimated, a range between 92 on the upside and 89.75 on the downside. Keep watching this space and don't let anyone tell you otherwise that this aspect does not matter. Leave them alone, do your own thing, or you will see your portfolios fall down the drain. Stay alert and keep watching. Friends, the dollar index done. Let's now go to the second most popular and highly traded tradable commodity on the NSE derivative segment, which is the Bank Nifty. Now, this index fell on 3 out of 5 trading sessions and lost 2.90% in the bargain, and it closed below its 25-day exponential moving average, which is again a red flag. Qualitatively speaking, the fall last week was more vicious compared to the previous week, and the swing low made on 23rd of February 2021, which is Tuesday, at 34,976 will need watching. Unless this index manages to close above this level, don't even dream of going long or start to bottom fish or bargain hunt. That could prove extremely dangerous. Technically speaking, you should think of buying only when a breakout is seen above Thursday's high of 37,232, and this is as per the daily chart. Take a look at the weekly chart on screen. Note how there are 2 consecutive weeks of declines by way of red bearish candles with extremely long upper shadows. Now, these are failed or abortive bids by the bulls to pull up prices. Like I said, these bids failed, and the price is still higher than the 25-week moving average. But the moving average itself is all the way down at 29,975. I don't think it's going to go there immediately, but at this point in time, a lot of put option writers would have got cleaned out. So the probability of this happening seems to be remote in this week itself, unless of some unforeseen, really severe negative event occurs. So let's not basically get into that panic mode right now. Now, in the week before last, this index was at number 3 on the most volatile list. Last week, it climbed 1 notch to number 2, which means that statistical beta or pure price volatility shot up exponentially. Now, the reason why I use the beta instead of the wicks is because I feel statistical beta is pure volatility as compared to wicks, which is a mixture of volatility and emotion-based expectation. Beta leaves out emotions completely out of the equation. Now, last week, the bond yields and the dollar hit this index hard, and keep monitoring these aspects for signs of trend determination next week. Last week, I expected a range between 37,700 on the upside and 33,950 on the downside, which held perfectly well in spite of all that volatility. The coming week may see an estimated, I stress upon the word estimated, range between 36,750 on the upside and 32,850 on the downside. Stay sharp and trade light, because beta or pure volatility is completely escalated and zooming into the moon, and capital preservation is what you should focus on at this point in time. So friends, the Bank Nifty done. Let's now go to the most liquid counter out there on the NSE, which is the Nifty 50. And it's also the lowest impact cost traded counter. Now, this index fell on 2 out of 5 trading sessions. But the falling days were far more vicious, as you can see on your chart, and this index wound up losing 3.02% on a week-on-week basis. Note on your daily chart how the negative divergence between the price and the RSI is marked with red arrows, which I had pointed out to you in my earlier videos and which played out exactly as planned. Now this index has also fallen below its 25-day exponential moving average and closed below it. Now that's a sign of near-term weakness. And just like the Bank Nifty, don't even dream of buying in unless the high of Thursday at 15,177 in the spot segment is not overcome on a sustained closing basis. I'm not saying intraday, but closing basis. Let the bulls prove to us that they are serious about pushing prices higher. Let them put their money at the firing line and risk their money before you and I should be putting our money on the line of fire. On the flip side, staying below Monday's intraday low, which is the 22nd of February, which is a significant low as per the Delta trading theory, which we follow, by the way, which is at 14,635 levels in the spot segment. If the Nifty stays below this level sustainably, especially closing below it all the time, it can open up the downsides and basically allow the bears to go short even more aggressively. Note the progressively higher blue dashed trend lines. Now, I spoke to you last week about the bump and run reversal. Once the very high steep trend line is violated, support will come at a lower trend line. Now, you have to basically draw 3 trend lines and support will come progressively lower and lower, which is what the bump and run reversal is. Now, support is basically likely at close to 14,200 levels. The weekly chart shows 2 weeks of declines, but the price still remains above its 25-week exponential moving average, which will provide support at 13,370, which is a long way off. So don't panic right now. This is early days yet. Let's not jump the gun. And the medium and long-term bull market still remains intact for now. We'll keep reviewing this situation every day. I'll keep updating with the statistical data in very simple terms on my social media accounts at the end of the day. Now, in the week before last, this index was number 14 on the most volatile list. But last week, it suddenly shot up by 6 notches to number 8. Which tells me that volatility is rising very aggressively and it's higher than what an average retail trader can handle. So be extremely careful, otherwise you could burn your hands out here. Trade light and expect sudden sharp moves in either direction. Last week I advocated a range between 15,525 on the upside and 14,425 on the downside. And both these levels held perfectly well in spite of whatever happened in the market. Now next week, I expect an estimated, I stress on the word estimated, range between 15,100 on the upside and 13,950 on the downside. Now, also stay with me till the end of this video because I have a very important market update for you. And friends, the Nifty is wound up now. I come to the most popular segment of this video wherein I give you 5 shares which are absolutely suitable for high beta, high impetus traders who will take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus in nature, and therefore you will take very large exposure or large exposure and wait for smaller price moves. Now, high beta, high impetus stocks list is led by UPL number 1, number 2 Steel Authority of India, number 3 Nalco, number 4 Steel Authority of India. My God, a lot of metal stocks here, and that too PSUs. And at number 5 is Tata Chemicals. Now low beta, low impetus stocks where you will take large exposure, wait for smaller price moves. Number 1, Motherson Sumi. Number 2, Amar Raja Battery. Number 3, Cholamandalam Finance. Number 4, PEL. And number 5, Muthoot Finance. Now friends, do remember beta has a way of changing day on day. So the hierarchy in this list will keep changing, and therefore do keep connected with me on social media, and we'll keep updating this as time goes by. Now for the critical market updates, I have actually 3 aspects to point out to you. I don't know whether you've taken this into account. Number 1, this is the month of March, the last month of the financial year. People basically reverse their entries, pay advance taxes, pay off their loans, recall their loans. So generally speaking, there is a slight liquidity crunch in the end of March as you progress towards March. Therefore, expect money to be not as easily available as it is in other months of the year. The biggest hint that you will get about the liquidity will be interbank call money rates. Keep monitoring these, and if the interbank call money rates are going up, expect the market to decline. It's very simple. Don't let the so-called experts tell you otherwise. The markets are simple creatures. Everything happens for a reason. The reason is financial. There is no such thing as a coincidence. Don't believe in coincidences. They are like Santa Claus. They don't exist. And keep monitoring the liquidity, like I said. The second aspect, this is for you and me as intraday leverage traders. From the 1st of March onwards, the second leg of SEBI's new peak margin rules will come into effect. What does it mean? It means that up to now, brokers were allowing you intraday limits of 4 times your usual stock exchange limits. From 1st of March, that intraday limit from 4 times will fall to 2 times. So people like you and me who stack our trades, pay money for 1 lot but take 2, 3, 4 lot positions, will now be able to take only 2 lot positions by paying for 1 lot. Which means either you require more money, or because it is the month of March where finance and liquidity is a little tight, volumes on the stock exchanges in the derivative space might fall, my dear friends. Do keep these aspects in mind, because as a trader, you must treat trading as a full-fledged business. This is not a joke to be trifled with. This is serious stuff. Big money is gained and lost in trading, and it is your job. You owe it to your family to put food on the table, to look after their interests, and you can't trade blindly. The third aspect, which is very critical, especially to those traders who are holding leverage long positions. Now, mark-to-markets can become a problem. If at all the market declines even further, brokers will start asking for margin calls, and if traders can't pay them on time, to avoid penalties, remember SEBI's new peak margin laws have increased the penalties on brokers who will pass on the penalty to their clients. Now, this is possibly coming at the worst possible time, March end. So if you have the desire to hold on to your long position, which is losing money, but you don't have the money, and in March end, if the cost of money goes up, which it is going as bond yields tell you, the bulls are slightly squeezed. Now that is something you will have to keep in mind. If the market continues to fall and remain below the Monday's intraday swing low, which I mentioned on the Nifty and the Bank Nifty, expect margin triggered sell-offs by brokers. Now this is something that will trigger a huge spike in volatility. So be extremely, please be extremely careful for the sake of your family, and trade light. And watch out, keep your stop losses in place, and don't get carried away on bottom fishing or bargain hunting. Friends, I come to the end of this video. If you like this video, please subscribe to my YouTube channel and Tell your friends about the quality work that you get here for thinking man's intellectuals game that we play here by sharing knowledge with each other, by referring my video to your family and friends. Coming up on your screen are my contact coordinates. Please connect with me. I'll look forward to hearing from you and have conversations going. We'll talk about markets, and I wish you all the best. Have a very, very profitable week ahead. Stay safe till we meet again in my next video. Thank you for watching. Take care of your trades and investments. Bye-bye.